Hello everyone and welcome to my channel. Today we will continue talking about how various cash flow activities are classified on the statement of cash flows, and we'll look at some examples. In part 1, we discussed that statement of cash flows reports cash receipts and payments from operating, investing, and financing activities. Further, it reports the net changes in cash resulting from these activities. If you haven't had a chance to watch part 1, I'm posting the link here and in the description below. Now let's look at some examples. We will look at several transactions and decide how each transaction will be classified on the statement of cash flows. The first transaction is issuing capital stock for cash. This transaction affects the stockholders' equity accounts. As we discussed in part 1, financing activities involve liability and stockholders' equity items. Cash received from this transaction will be reported as a financing activity. The second transaction involves purchasing land and buildings for cash. We already know that investing activities generally involve long-term assets. The cash outflow from this transaction will be reported under the investing activities section because land and buildings are long-term assets. Therefore, this will be an investing activity. The third transaction is redeeming bonds for cash. A bond is a fixed obligation to pay that is issued by a company to investors. Issuing bonds is recorded as an increase in liability. Redeeming bonds means that the company has repurchased its bonds before maturity, resulting in a decrease in liability. The cash outflow will be reported as a financing activity on the cash flow statement. The next transaction is the sale of equipment, assuming no gain on this transaction. The sale of equipment is an investing activity. Remember that investing activities include purchases and sales of long-term assets. Let's also look at some transactions that are recorded as expenses but don't involve cash payments. For example, depreciation on machinery is an expense and is subtracted from revenue to determine net income. However, there is no actual outflow of cash due to depreciation. Since depreciation expense was removed from the net income, depreciation on machinery will be added back to the net income in order to compute cash flows from operating activities. If you would like to know more about depreciation and how it is calculated and recorded, watch my video How to Calculate Depreciation. I'm posting the link here and in the description below. The next transaction is paying dividends with cash. This transaction reduces retained earnings, which in turn reduces the stockholders' equity. Therefore, paying dividends will be classified as a financing activity. The next transaction is the sale of equipment for gain. A gain on sale of assets occurs when an asset is sold for more than its carrying amount. The carrying amount is the purchase price of the asset minus any subsequent depreciation and impairment charges. The gain is classified as a non-operating item on the income statement of the selling entity. The gain on sale of equipment is added to compute net income. As the value of gain will be included in the investing activities section, we deduct it from net income under the operating activity section. Let's take a closer look at the sale of equipment that resulted in a gain. If you are not familiar with accounting for the disposal of fixed assets, I am posting the link to the video here and in the description below. A business buys equipment for $10,000 and subsequently records $3,000 of depreciation, resulting in a carrying amount of $7,000. The company then sells the equipment for $7,500, which results in a gain on sale of assets of $500. The gain of $500 was added to compute net income when net income was calculated. However, $500 is also a part of the cash received as a result of sale and will be included in the investing activities section. Therefore, we deduct $500 from net income under the operating activities section. The next transaction is a repayment of advances made to other parties. Giving advances to other parties is not a part of the business's usual operating activities. Advances are usually recorded as other assets. When advances are paid back, the cash inflow is classified as an investing activity. Note that investing activities will not include loans and advances made by a financial institution, which are liabilities for the company. The next transaction is exchanging furniture for office equipment. This transaction doesn't involve an exchange of cash. Therefore, it will be reported as a significant non-cash activity in either a separate schedule at the bottom of the statement of cash flows or in the notes to the financial statements. The next transaction is acquiring debt instruments of another entity as investments. It will be classified as an investing activity on the statement of cash flows. That's all for today. I hope you found this video helpful. If you did, please subscribe, hit that like button, and ring the notification bell so you're notified when we release more videos like this. Visit my channel for more videos on financial and intermediate accounting. Please leave comments and share this video with anyone interested in learning accounting. Thank you all so much for watching, and I hope to see you all again in the next video.